As you begin your journey into the world of stock market investing, it is crucial to determine your preferred approach. Some investors prefer to actively research and analyze individual stocks, while others take a more passive approach. Consider the following statements and choose the one that best describes you. I am an analytical person who enjoys crunching numbers and conducting research. I do not enjoy mathematics and do not want to spend a lot of time on homework. I have several hours each week to devote to stock market investing. I like to read about the various companies I can invest in, but do not want to delve into any math-related tasks. I am a busy professional and do not have the time to learn how to analyze stocks. Regardless of which statement you identify with, know that you are still a suitable candidate for becoming a successful stock market investor. The key is to find an approach that aligns with your goals and preferences. There are several ways to invest in the stock market, each with its own set of advantages and considerations. One option is to invest in individual stocks, which can be a rewarding choice for those who have the time and inclination to thoroughly research and evaluate different stocks on an ongoing basis. However, this approach requires a significant amount of effort and may not be suitable for those who do not enjoy analyzing financial data and reports. Another option is to invest in index funds, which track a particular stock index such as the S&P 500. Index funds are often passively managed, which means they aim to match the performance of the underlying index rather than outperform it. This can make them a more cost-effective and lower-risk choice for many investors. Finally, robo-advisors are an increasingly popular option that allow investors to have their money managed automatically by a computer program. Robo-advisors typically invest in a diversified portfolio of index funds that is tailored to an investor's age, risk tolerance, and financial goals. They can also help investors optimize their tax efficiency and make changes to their portfolio over time. When determining how much to invest in stocks, it is important to consider the time horizon for your investments. It is generally recommended to avoid investing money that you may need within the next 5 years or more in the stock market due to the inherent volatility and unpredictability of stock prices. This includes funds for emergencies, tuition payments, vacations, and down payments, among others. While the stock market has the potential to generate substantial returns over the long term, there is always the risk of short-term market fluctuations and downturns. For example, the market saw a significant drop of over 40% in 2020 due to the COVID-19 pandemic, although it subsequently rebounded to reach new highs. Therefore, it is advisable to keep money that you may need in the near future in a more stable and accessible form, such as a savings account or short-term bond fund. Asset allocation is the process of dividing your investable assets among different asset classes, such as stocks, bonds, and cash, in a way that aligns with your investment objectives and risk tolerance. It is a key aspect of portfolio management and can help you achieve your financial goals while minimizing risk. Several factors influence an individual's asset allocation, including age, risk tolerance, and investment objectives. As a general rule, it is recommended that younger investors allocate a greater proportion of their assets to stocks, as they have a longer time horizon and can afford to weather market volatility. Older investors, on the other hand, may prefer to shift their assets towards more stable investments such as bonds or high-yield CDs, as they may be reliant on their investment income in retirement. A quick rule of thumb to determine a suitable asset allocation is to subtract your age from 110, which gives you the approximate percentage of your investable assets that should be in stocks. The remainder should be in fixed income investments. For example, a 40-year-old investor following this rule would allocate approximately 70% of their assets to stocks and 30% to fixed income. However, this ratio can be adjusted based on an individual's specific risk tolerance and investment objectives. To invest in stocks, you will need to open a brokerage account, which is a specialized type of account offered by financial institutions such as TD Ameritrade, E-Trade, and Charles Schwab. The process of opening a brokerage account is typically straightforward and can be completed online in a few minutes. You can fund your account through electronic funds transfer, mailing a check, or wiring money. When choosing a brokerage, it is important to consider the type of account that best meets your needs. The two main options are standard brokerage accounts and individual retirement accounts, IRAs. Standard brokerage accounts offer easy access to your money and are suitable for short-term investing or building a rainy day fund. IRAs, on the other hand, are tax-advantaged accounts designed for long-term retirement saving. They come in two main varieties, traditional and Roth, and there are also specialized options for self-employed individuals and small business owners, such as September IRAs and Simple IRAs. In addition to the type of account, you should also compare the costs and features of different brokers. While most online brokers have eliminated trading commissions, there may be other differences in terms of educational tools, research access, international trading options, and the user-friendliness of the platform. Many brokers offer a demo version of their platform, which can be a useful way to test out the user experience before committing any funds. When choosing stocks to invest in, it is important to diversify your portfolio, invest in businesses you understand, and avoid high volatility or penny stocks. You should also become familiar with the basic metrics and concepts for evaluating stocks, such as value and growth potential. Diversification can help reduce risk by ensuring that your portfolio is not overly reliant on any one stock or industry. However, it is also important to focus on businesses that you understand and are comfortable evaluating. For beginners, it may be wise to start with more established, stable companies rather than high-risk, high-growth stocks. Familiarizing yourself with the principles of value and growth investing can also be helpful in identifying attractive investment opportunities. Our guides on value investing and growth investing can provide a useful starting point for learning more about these concepts. One of the keys to successful investing is to adopt a long-term perspective and focus on buying shares in quality businesses at reasonable prices. According to Warren Buffett, one of the most successful investors of all time, you do not need to pursue extraordinary strategies to achieve extraordinary results. Instead, the key is to hold on to shares in strong businesses for the long term, weathering any short-term market fluctuations. By following this approach, you can expect to achieve excellent investment returns over time.